and we're good to go. So welcome guys to the free owner's earnings webinar. Today I'm going to show you everything about owner's earnings, how to calculate it, why it's so important, what goes into it, why it's one of Buffett's favorite metrics to use, how I use it to evaluate every single company I look at once I get down the road of investing in them, how to navigate some of the complexities, the many complexities of owner's earnings. David, you were in on one of those calls where we talked about owner's earnings. It can be super complex. So I'm going to go through all that, and by tomorrow, by the time you're done with this meeting, I guess, you should be able to at least have a better understanding of owner's earnings and begin to use it yourself and evaluate companies yourself. So having said that little mini intro, I'm going to share my screen with you guys. Let me know when you can see my screen, please.
Yeah, I can see it.
Okay, so this is ASXFY. The reason I did this because the last time I did a free webinar like this, we evaluated this company. So I want to do it here. I want to finish kind of the evaluation here of ASXFY, and I'm trying to figure out how to see your guys' chat when I'm sharing a screen. I cannot, apparently. David, do you mind letting me know if there's a chat? Oh, there we go.
Oh, you can see.
Okay, there we go. So I'm going to move this over here so I can see if you guys have any questions. So all you need is Morningstar main website. I have this up just because I always have this up when I'm evaluating a company, but all you really need for owner's earnings is the income statement, balance sheet, cash flow statement. Already got up here, just have to reload. Here. Okay, also, David, you already have this. Alice, I hope I'm saying your name right too. If not, let me know. I want to say your name right. So this is my owner's earnings template. David, again, you already have this. I use this, again, every time I evaluate a company within their owner's earnings. Why? Because I don't want to miss a step. Again, if you miss a step here, the numbers could be wildly off and tell you the wrong story about the company. So let me mute my phone, actually. Just heard it go off. Okay. So I've already got this set up. ASXFY owner's earnings calculation done today. I haven't done them yet. This is a template I use over and over again. This is from another company. This is IDXY, David, that we analyzed a while back with Shafiq and our other students. So owner's earnings is net income plus depreciation and amortization plus or minus other non-cash charges minus full capex plus or minus changes in working capital. So before we get into the actual calculation, David, what are we trying to do with owner's earnings?
It's sort of like you're trying to work out how much this company need to operate without, so how much money you can take out from the company without harming its competitive position.
Perfect. So
let me think of another analogy.
You used before in one of our coaching sessions, it was a great analogy about the house price, I think, wasn't it?
House price.
Or was that a different
one? The house price?
Buying a house? Or was that a different analogy for a different session?
Buying a house, the rent thing, right? Oh no, buying a house, right.
Maybe
that was for.
that was
something else, I think.
Okay, that's fine. So the main thing we're trying to do here is we're trying to figure out exactly what David said. I put it slightly differently though. We're trying to figure out, as if we were owners of the entire company, what the company earns and what we can take out of the company without harming its competitive position. So I just put a slightly different wording on it than David. Same thing, again, just slightly different wording. So the reason we do that is because we want, as value investors, deep long-term value investors, we want to think of things as if we are buying the entire company. We want to value things as if we were buying the entire company, not just a piece of paper, not just a stock. We're buying the entire business. Is the entire business undervalued or overvalued? Is the entire business great, average, bad? Where can it get better? All these kind of things. Owner's earnings helps us figure that out. So the reason I'll go through the calculation and why everything's in here one by one, and then we'll actually get to the calculation. So net income is in here. This is the bottom line kind of profitability for a company. I don't use net income. As David knows, I don't use net income in any of my analysis because it's easy to manipulate. Essentially, make your net income whatever you want based on how good your accountants are, how good your lawyers are, and how good they are at navigating the tax rules and regulations in whatever country they're in. So we use net income here because that's based on what the company says they are earning on the quote unquote bottom line. We add back these numbers, depreciation and amortization. David, actually, why do we add depreciation and amortization back in? Do you remember?
Depreciation. No, I don't think I remember. It's because it's the ongoing cost or something like
that. Sort of.
The asset's going to get worth less and less, so you have to take that into account because you have to replace the asset eventually.
Yes. So the reason we add depreciation and amortization back in is because they are real-world accounting costs. Assets depreciate in time, no matter what they are. Cars or vehicles, watches, electronics, they get worth less over time, or they become worth less over time. Same thing with big equipment machinery. But having said that, they aren't necessarily a real world cost in many cases. Unless the company has to continually replace their equipment, sometimes depreciation, the stuff gets depreciated and amortized off the balance sheet within 5 to 10 years, but they can still continue to use it, that equipment, for 10, 20, 30 years if they take good care of it. So we add these back in because it's not necessarily a real world kind of expense, depending on the company. Again, if a company's turning inventory or equipment fast, then that might be a different situation. But I don't really invest in those kind of companies, to be honest with you. I would still probably add this number in there. Let's say it's a heavy manufacturing company, for example, and I would still add the number back in here just to be safe. But you would have to probably be a little bit careful. Other non-cash charges. We add or subtract these back in here because we, again, as a full business owner, we want to know the cash that is coming in and out of the business. So this is where we add this number is. Full CapEx. So this is one I get questions on all the time. Capital expenditures. If you've ever researched owner's earnings at all, Alice, have you ever researched owner's earnings at all before this? Okay. So most other people, when they talk about owner's earnings, they talk about what quote unquote maintenance capex, what they call maintenance capex. Essentially, maintenance capex is their estimate of capital expenditures that is required to continue running the business day to day, continue running operations day to day. I use full capex, A, because it's a more conservative number because you're subtracting the full capital expenditures here, and B, because it literally takes hours sometimes to calculate maintenance capex because there isn't in financial statements a section that is called maintenance capex. You literally you have to guess by reading word for word, line for line in the financial statements what costs or what expenses are in this maintenance capex number. So to save time and to be more conservative, I use full capex to take out. Does that make sense, guys?
Mm-hmm.
Alice, is that good too? Make sense? Haha, perfect question. So, yes, I don't. David, how often?
Yeah, he doesn't get. We don't talk about growth at all. It's not a thing we talk about. I've never heard him talk about growth. since the last 3 months I'm talking to.
So I don't talk about growth at all. I realize companies grow, they fluctuate, they go up and down. I realize that. But I want to know at the point in time I'm evaluating the company, what I value it at that point in time based on its current numbers and its past numbers. If the company has some great prospects in the future that can be proven in their real world stuff, that's icing on the cake to me. But I don't include that in the valuation. So I don't do DCF valuations. That's another question you're probably thinking. I don't do DCF valuations at all. I've never done one. They don't make sense to me. Why? For that reason, because DCF valuations require you to kind of guess at the growth. DCF valuations use beta, which if you've been on the blog at all, you've probably seen that I hate beta. It makes zero sense to me, and I don't use it just because I don't think volatility is, I don't deem volatility as risk, which beta essentially does. And also because DCF valuations can sometimes have dozens of individual metrics in them, and if you're off by 10% on one, the entire valuation can be thrown off by a huge amount. So if you're off by 5% on 10 of the metrics, your evaluation is completely skewed. So everything I teach, and David knows this, everything I teach is I do it manually. I do it either by hand or on the computer like this, and I calculate everything myself. I don't use any spreadsheets to calculate anything for me. I don't use DCF valuations, anything like that. Growth, again, icing on the cake to me. To summarize your question, icing on the cake to me if it's a good thing. If it's a bad thing, then it can be a red flag. Let's say Sears. I'm going to talk about Sears with coaching and masterclass students tomorrow. Sears, we're doing an entire case study on their rapid fall. Essentially, they've lost 99.9% of their value since the year 2007 because the retail industry in the United States and around the world is dying. So if there was a company industry like that, it's obviously a huge negative thing. I don't invest in retailers for that reason.
I think it's rare to do a case study on failure. Most people do a case study on success story. I think it's quite interesting.
Well, I'm a big believer in learning from successes, obviously, but also failures. There's a thing by Charlie Munger, invert, always invert. So when there's a huge opportunity like this to learn from a failure of what not to do, I think it's incredibly powerful. I mean, their market cap, and we'll talk about this tomorrow, David, you and I and the other students in the masterclass and coaching program, we'll talk about this tomorrow. But essentially since 2007, Sears has gone from a $20+ billion company to essentially its stock being worthless because they're in and out of bankruptcy. In 12 years time? That's an insane loss of capital. Insane. $20 billion essentially just lighted on fire and it's gone is essentially what's happening right now. So to get back to this, or to your question, Alice, that's why I don't factor growth into anything I do. Does that make sense, both from a negative and a positive sense? Cool. So changes in working capital. This is where things get confusing. Correct, David?
Yeah, you have to get the original.
I'll talk about this more later when we get to that part of the calculation, but essentially changes in working capital is changes in your year-to-year working capital run the business. Inventory, yes, year over year. Inventory, accounts receivable, those kind of things. I'll go into more detail on that because, again, that's going to be super complex. But everything makes sense so far. I want to make sure everything makes sense so far before we get to the actual starting to calculate this number. Cool. So, all right, let's get to that. Okay. Yes, to answer that statement, yes. I am, and I tell this story to students and clients all the time, is I haven't invested in anything in a real world stock in almost 4 years now because I can't find anything that meets my ultra strict criteria. I know people, and this was a couple years ago, so I don't know if they're still doing the same thing, but at that time, I hadn't bought anything in a year and a half, 2 years, and they were still buying something every month. I'm not only ultra conservative and stick to my metrics and what I require from a company, but I'm also willing to wait. I'm not just going to buy something just to buy something just because I'm going to get impatient. I'll learn or do other stuff during that time. It improves your results. But it also leads to this year, and I'm going to release this next week, I think, on the blog, my 2018 performance review. It also leads because my stocks picks, I think I had 10 or 11 in the stocks that I own in the portfolios I manage. Now it's down to like 6 or 7 after buyouts and mergers and stuff like that. And because I haven't bought anything, my portfolios were down this year for the first time ever. But that's because they fell from their all-time highs that they were at, not necessarily because they're bad companies or anything like that. So just interesting. And value investing, to kind of piggyback on that, value investing works best when, you guys know? Either of you? When does value investing work best?
Oh yeah, in a down market.
Yes.
Or down, or in a market that's not rising, or down market.
Yes, if the market is down or kind of just stagnant, value investing works fantastic. If the stock market is going straight up like it has since 2009, 2010, something like that, value investing underperforms massively, and I found that out this year the hard way. So, first number, net income. David, what is my number one rule here when we get here?
Oh yeah, make sure it's annual. Oh, and make sure it's in the right currency and it's annual. That's right.
Yes. So this is in currency Australian dollars. That is ultra important because every currency around the world has different exchange rates. So if, for example, I had this in US dollars, this would be about 25% cheaper. It would look about 25% cheaper. Is that correct?
Yeah, so 25 to 30%, but just use 25 for the sake of it.
Okay, yeah, 25% cheaper than its real world kind of value, because again, you have to make sure it's an AUD and not for example, if it was something like Thai baht, it would be hundreds of times cheaper looking. So you have to be very cognizant of being in the correct currency. Second thing that David mentioned, always make sure you're on the right thing. And I'll probably mess up here because I still mess up on this to this day. I'm always on the quarterly numbers when I'm on Morningstar, except for when I'm doing the owner's earnings calculation, especially when we get to the balance sheet, because that's year over year. For this, it's not that big of a deal. This is the balance sheet. This one. So for this, it's not that big of a deal because this company just released results. The last time they released results was 3 months ago, something like that. So these are the most updated results. But you'll see later, I'll probably there'll probably be a point where we can illustrate that.
Can I just do a summary of what you're saying, just for the sake of it?
Yeah. Yeah, no, go ahead. Like I said, I want everybody to understand everything 100%. So if you feel things could use better explaining, either write it out or let me know. I don't have an ego when it comes to this kind of stuff. I just want to help people. So also make sure you're in the correct area there. See how the numbers switch, thousands, millions, billions. So you have to make sure you're in the right number on all of these pages. Okay, 445. And again, I round up, as Dave knows, I round up on all these numbers. If we get to one where there's kind of a fraction, I round up. Plus or minus amortization, depreciation, amortization would be on the cash flow statement. That I was going to say, that doesn't make sense. They don't have a depreciation and amortization, but this company is a, do you guys remember what this company is? Yep, stock exchange. So they don't have much property, plant, equipment, anything like that. So they haven't actually depreciated anything in 3 years now. So 0 plus or minus other non-cash charges. Again, should be on the cash flow statement. They don't have any there either. Zero minus full capex. Okay, well, this company is going to be pretty boring to look at, to be honest with you. So, Alice, this company looks like it's going to be pretty boring to go through. I don't, whenever I do a case study like this, it doesn't matter if it's for a free webinar like this or for students. I don't look at the company in advance when it comes to the specific calculation. Yeah, I take, usually it's on the, it's on this statement right here. So this company is going to be pretty boring. So we should be able to go through this pretty quick, and then I'll find another company we can evaluate that'll have all these numbers in there. But again, I don't look at the companies in terms of what I'm specifically teaching before that day, just so I can teach it from a fresh perspective and not have my biases in there. So this company's going to be boring. I'm going to tell you guys right now. So minus 0, 0, 0, 0. Okay, so calculation hopefully makes sense up to here because there's net income and then a bunch of zeros. So I've already explained most of this. This is where it won't be the next time. The next time we look at a company, we should be able to breeze through this company pretty fast. So this is why changes in working capital is so confusing. This is the entire calculation just for this number, this question mark right here. Does that look confusing or straightforward, Alice?
That's probably to say I'm confused as well. Change. Oh, it's like year-on-year change in account receivable plus year-on-year change in inventory. But
yes. So all numbers in the changes in working capital calculation are either plus or minus the change in the last year's number. So here's an example that I go through. This is just a fake example right here. So if a company has an accounts receivable of 200 in 2013, but its accounts receivable rose to 300 in 2014, it would have a plus 100 AR for the calculation. Does that make sense?
That makes sense.
Alice, that makes sense? Okay. So the plus minus part is pretty straightforward. This is where things get confusing. Because if there's a negative here, you start out negative, so you have to figure out if it's supposed to be negative and a positive. And again, we'll get to that either with this company or another company, most likely. So plus minus changes in accounts receivable in the last year. So we go to the balance sheet. Again, year to year. So what should this number be? Based on that conversation we just had, what should this number be?
What are we looking for?
The year-to-year change in accounts receivable right here. What should this number be? What should the change?
It has to be negative because it's gone up, right? It's gone down. There's 373, take away 1125 or whatever that is. Yeah, so there's negative. Is that right?
I got negative 752. That's what I got.
Oh, wait, let me check. Let me check.
Let me see if I fat fingered my calculator here. Yes, 373 minus 1125.
Did you get minus 752 or what was it?
752, yes. Sorry, did I say 725? So there was a year-to-year change from 2017 to 2018, and you always do it from this year to this year, or this year to this year, or this year to this year. Does that make sense? You don't go back from this year to this year. Unless it's a bigger number, obviously, over here, then you do that. But
That's a good summary.
yes, older year, new year, correct.
Isn't new year subtract the older year? That's how I use it. So you're subtracting 2018 from.
Yes. Normally, Alice is correct. Normally, you go from here to here, but I forgot this company just released. These are the most recent annual numbers. Because most of the time you'll see here, this will be the trailing 12-month numbers here. So correct. So 373 minus 1125.
We're looking at the change from the previous year, so you gotta take the current year and then you take away the previous year. That's what I thought. You know?
Yes, correct. You're correct. I made a mistake there. So there was a 752, negative 752. So before we put that number on the sheet, what does that change here mean? What does that negative 752 mean in terms of the owner's earning calculation? If you guys don't know, just say I don't know.
Just chuck in minus 752 into the earnings.
Into, where's that? What is
into
this?
the working capital.
What does that change mean? From kind of a real world perspective, it's not necessarily for the owner's earnings. What does that mean?
The account receivable went down by 752 million. I don't know.
From a deeper perspective, though, what does that mean?
Oh, right.
That the company essentially saved, yes, correct. They essentially saved $752 million in cost, or in potential cost this year, because their accounts receivable were $752 million less. Does that make sense?
Oh, so they collected more money, like Alice said?
Yes, they should have. I can show you that later. So
they should have.
Well, it depends on the other numbers too. It's not just this one number. So that means from a real world perspective that they essentially gained $752 million from last year. So the reason we do negative 752 is because we assume that they're going to use the higher number. Going forward, and again, we could probably do something different here because this company's numbers are generally lower, but I don't mess with the owner's earning calculation at all. I don't use averages. I use what the real numbers tell me because I don't want to guess. I don't want to be on the high side of things. Again, I'll say this over and over again. David hears me say this constantly. I always want to be conservative. If I'm wrong, at least I'm wrong in the conservative side, and my upside should be higher. Does that make sense? Okay. Alice, everything there makes sense? Perfect. Okay. Say plus or minus changes in inventory. This company has no inventory, correct? Oops. There's my family. Or part of my family. I guess I have another daughter since then.
Congrats.
Thank you. She's turned a year old January 9th.
Oh.
So, prepaid expenses. Again, this company's gonna be boring. So 0, other current assets.
What? They have no inventory. What the hell?
No, they're a technology company.
Yeah.
So they have no other current assets either.
What? But no prepaid expenses.
I would
They
guess,
didn't prepay for anything.
I would guess not.
What about rent? I don't know.
Payables.
That's payable.
Okay, payables will be on here. Account payable. Okay.
Well, thank God for that.
So,
Alright.
354 minus 1092. But go back up to the calculation. This is where negative and positive get flipped around. So what should this number actually be? Negative 738 or positive 738?
Possible.
Remember, we're trying to be conservative. So what should this number be?
Account payable.
Any guesses, Alice?
So if you calculate normally it's negative 738, is that what you got? Like if you go from the 2018
Yes,
account
negative 738.
payable, like 354 take away 1092 gives you.
Yes. So what should this number really be, though? Remember, the negative and the positive is flipped here.
But why does it flip?
Because these are liabilities.
Oh. So we add on. So we add into like. So we add into liability.
Remember, we want to be conservative. This is negative, so you're subtracting a negative. So I always turn this positive when it's negative like this. Because if you're adding 738, yes, correct. So if you're adding $738 million, you're going to be on the conservative side here. Because you should assume, based on what we talked about above, they may go back to this number again, correct? Does that make sense?
Mm-hmm.
Oops. Oops, where's the calculation at? Plus.
Oh, yeah, that makes sense.
Yes, Alice, yes, it does. And the next company, once we get through this, which again, it shouldn't take much longer. Once we get through this, I'll try to find another company that will be kind of more typical of what you'll see when you calculate owner's earnings. Plays a massive role in this, because if you don't flip the symbols around, obviously that's almost $1 billion. That's $750 million. So that's $750 million difference either in the right way or the wrong way when you're calculating this number. Obviously that makes a huge difference, correct? So yes, these numbers, and that's why I take so much time. This is what we talk about. I probably talk about this, have one-on-one individual coaching sessions with people in the masterclass and coaching program about this more than anything else, because this is such a complex thing. And again, it's not necessarily here because the numbers are pretty straightforward so far here. But again, if we get to
understanding it's a tough part. The number's not hard.
And then once you understand it, it's easier to do. And that's why I build this as literally saving years of time, because it took me years of time to figure out how to calculate this number properly. So what's next? Current liabilities. Okay, 0. Okay, and this is on the back on the cash flow statement. Changes in, there's usually, again, changes working capital here, but again, we'll get through this one so we can go through another company faster. Or that's more of a real world. This is kind of a unique company. So just for this one number, and I want to illustrate this point here, because I still, when we get to more confusing companies here that don't have a lot of zeros here, I want to illustrate this point, is that even I, who have been doing this for 12 plus years, this is why I want to illustrate this point. I still get bogged down in this minutia of trying to get the exactly correct number. It's important at this stage to remember the bigger picture and what we're trying to do here. We're trying to simply figure out what this company, from a real world perspective, what this company earns that we could potentially take out if we own the entire company. So this gives us an idea of how well the company's operating, its profitability, if we can improve profitability, if we can cut costs, these kind of things is what this number essentially shows us. So at this point, don't get bogged down in the minutia. And I still, again, to this day, I sometimes have to, if I'm trying to get really stumped on a number, I sometimes have to mentally back myself up and try to figure out, am I being conservative? If I am, I move on and go with the best possible number, because I don't want to get stuck here for hours trying to figure out this one number, for example. As long as I'm conservative, I don't care if I have the exactly right number. Again, David and other students have heard this quite a bit. I'd rather be precisely, what is the saying by John Maynard Keynes? I'd rather be vaguely right than precisely wrong. So I'm a big believer in that mindset as well. Of course, I want to be as accurate as possible, but I have to keep the bigger picture in mind as well. I could be stuck here for literally hours. So, yep, there you go. So 752 negative plus 738 equals negative 14. So minus 14. So here we go. We bring these numbers from up here.
So we're hoping for a high number, obviously, right?
Why are we hoping for a high number?
So the true earning of this company is higher than what the net income says, so you can take out the cash, excess cash.
Perfect. So yes, that's one sign the company may be undervalued. If, let's say, just for argument's sake, this was positive 1,400.
All right.
Just for argument's sake, this was positive 1,400 here. That means the company could be potentially massively undervalued, because most people wouldn't consider these numbers at all right here when calculating their earnings. Most people look at net income and nothing else. I never look at net income other than for this calculation. I don't rely on net income at all. I always rely on free cash flow, owner's earnings, or EBIT, which is operating income. Never look at net income. But this is negative, so what does this mean? Oop.
431.
Yep. Oop. That finger in. So this means the company is slightly overvalued based on this one metric. Again, this isn't a big deal for this company because this company doesn't work on their assets or work anything based on their assets pretty much at all. So
what was the net income for this company? 445.
Yeah.
Oh, okay. All right.
But again, for these kind of companies, it doesn't really make sense. But I want to illustrate something down here. So 431 versus 445. Actually, we'll just move on. I'll illustrate this for the next company. Do you guys have a hard asset company you'd want to look at? If not, I have one in my mind that I own that we can look at and do an actual owner's earnings analysis on it.
I don't have a preference to pick something. I don't know. Does Alice have a preference?
Alice, do you have a company? All righty. So this is a company I've owned for years. They, what they do is, they are in sheet molding, plastic fiberglass sheet molding for mainly heavy trucks in the United States and around the world. I think mainly the United States. And also in the last couple of years, they've also been getting into working on these kind of products for boats as well. So hard asset company. And this should be more interesting.
So you know this company quite well.
Oh yeah, I know this company very well. I having said that, I haven't calculated their owners earnings in a while. So okay, so what I'm going to do here, because it's a small company, I think it's like a, what is it, $80 million company, something like that.
Well, the numbers in million?
They were.
1,000.
So it's a $68 million company. So I'm going to put these 2000s here because it's such a small company.
1,000. Oh, like the net income is like 9 million or something.
Net income is
5 million. All right.
for last year, the trailing 12 months, and that's again a problem with this company is they're a cyclical company.
Oh, massively cyclical.
Yes, they are. So let me find another company. Let's see.
That's interesting that the revenue have grown every year, but then since last year, the net income literally like went free fall.
Yeah,
That's
they're a
quite
very
interesting.
cyclical company.
Very interesting.
So this should be a good one. They have hard assets. This is another company I've owned for years. I just want to make sure they actually have all the numbers before we get into the calculation. Okay, depreciation, prepaid expenses, blah, 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 blah. Accounts payable, perfect. Working capital, awesome. So this should be a very good look at what this company will be doing or has done. Okay. I'm gonna save this.
Io přestaňte dopisovat a udělej se jako foll.
What's the background noise?
Not sure. I thought it was you. Somebody else joined?
No, on my end, is it?
Not sure. Okay, same thing here. Net income. These are in euros. Okay, so I need to make note of that. The reason I make notes of everything, Alice, David again has heard me say this a lot, is because I want to go back months or possibly years from now to see what my thinking was at that particular point in time when I was analyzing the company. I don't want to guess at what I was thinking. I want to actually see what I was thinking, what I was calculating on. So yeah, normally you want the full year numbers here, but they should be reporting. They should be reporting their annual report and 2018 financial numbers here. So these should be pretty close. So I'll just use these numbers right here, the trailing 12 months to 2022. And that's again, if you're evaluating a company that's not near an annual report, it's kind of, again, another one of the nuances. The reason I don't want to do this to this is because that's what, 2.5 years ago at this point, 2+ years ago at this point. This is more than a full year ago. So I don't want to do these numbers because these aren't necessarily a reflection of what the company is doing at this point in time. Does that make sense? Okay, I'll go back up to millions. Make sure we do it all. Right. So 157 plus depreciation, amortization. 14. Plus minus other non-cash charges. Depending on the company, it will either say charges, another non-cash items, or other non-cash. What is it? What's the terminology on here? Non-cash charges. Same thing. Yeah, non-cash is the keyword, correct. Full capex again. Full capex. 18 plus, and then we go down here. Okay, so let's do the calculation. Back balance sheet. Annual. Okay, so this one actually is going to be perfect. This one doesn't show. So why I'm kind of sighing is because the numbers aren't going to be apples to apples. Do you guys know why? The numbers aren't going to be apples to comparison. Do you guys know why? On the other screens, trailing 12 months was over here. This one is not. So we're going to have to manually calculate everything. We actually should be able to just use this number because they reported numbers recently. So these should be the most recent numbers. That makes sense. That line of kind of my own thoughts, my talking out loud. Does that make sense? Yes. So which number would we compare this to for the change in working capital, annual year-over-year change in working capital? What of these numbers would we compare this to? 2017-09, 2017-12, 2018-03, 2018-06. Which of these do you guys think? Perfect. So yes, compare this number to this number. This number to this number. That makes sense, guys? Perfect. Dave, you still there? Okay.
Yeah, I just unmuted because of the background noise. I was like, what's the background?
Okay, so 149 minus 171, correct? Is that correct, guys?
Yeah.
Okay, so negative 22. Inventory 66 minus 72, correct?
Dobrý večer, úvodní zpráv na Primě. I dnes jsou pro vás připraveny ty nejdůležitější informace.
Prepaid expenses. So 180 minus 80. Again, correct?
100.
Okay, this is our first one that's actually positive for either company. Does that make sense, guys? Okay. Idle current assets, 10 minus 10, so 0. 0. Okay, here's where we flip things around, remember?
Box, speaking, return.
So, accounts payable. I think it must be Alice. That's fine. So 40 minus 57 is a negative 17, correct? But because we flip them, what is this number? Yes, perfect. Plus 17.
Tak ty peníze můžou právě získat od exekutora, které ocenit na své náklady a uzavření exekuce nedávají zjistit, že jsou bez dluhu.
Obdobný soudní spor se povede i s prezidentem exekutorské komory Vladimírem Vášelem. I on odmítá vracet peníze, které v průběhu později zastavené exekuce vymohou na svoje náklady.
I'm trying to get there, David. There we go. Okay, now where am I? Okay, so where were we? Current liabilities, changing current liabilities. We use these numbers, the totals. So 120 minus 137 equals negative 17, which is a
Negative and a negative positive.
yes. And then changes in working capital 6. Okay, so here's where we're getting to the interesting stuff. So 6 to negative 2. Oh no, I'm on the yearly. Where are we at here?
6 minus 2, 8.
So you can see the mistake I almost made there?
Yeah, that's the 2013.
So 6 to negative 36. So this is, what should this number be?
6 minus 36. Oh, positive 42.
Yes. So every time I teach this, people get tripped up on this. So I must be either getting better at teaching this part of things, or you guys are just incredibly smart, one of the two. So normally this trips out people when there's negatives and over here and stuff. So you guys have the correct number. I don't really, I'm used to explaining this more, but apparently I don't need to, so.
I teach math, so I had to know this stuff.
So 22 negative minus 6 plus 100 plus 17 plus 17 plus 42. 148 positive. 8 positive. So I already brought the numbers down. David, here's your example right here. So I get positive 277. So what does this number being larger than this number mean?
Oh, it says on if O is higher than net income, it's just one sign that the company can be undervalued.
Yes, and this is almost 2 times
double, almost
this
double.
number. So essentially, what most people do, and this is why I do this calculation, is most people look at net income only. If they look at other things like operating income or free cash flow, they look at those only. Those don't necessarily always tell the true story. These, in my opinion, this calculation right here, owner's earnings, is even more of a kind of real world number on the profitability of a company in a real world sense than even free cash flow.
But most of the value, like if you look at the owner's earning calculation, most of the value is in the changes in working capital, which is 148, right?
It's actually here in prepaid expenses.
Yeah, so that's where most of the I guess the hidden value is sort
So
of.
what does
So,
that mean? Do you guys know what that means? Because most of the value comes from prepaid expenses.
well, they haven't been paid yet. Have they been paid?
Let's see.
Oh, so they prepay for the expenses in advance. So you
Oh. So essentially from here to here, they've prepaid $100 million more in expenses than they did in the prior year period. So essentially what they did here is they prepaid these expenses now when they have the cash, so they can either use their extra kind of capital or what's the best way to put it? Their suppliers kind of money to, they can use that to invest in their other companies. They can use that to invest their future money that they won't, this $100 million that they won't have to spend in the future. They can use that money once they earn it back to invest in the company, to invest in marketing, to invest in better processes, patented processes. This is where we get into investment float. These kind of things are investment float, essentially using other people's money to invest in your company to generate higher returns. Does that make sense? This is one of the reasons Warren Buffett loves this number so much, is because you can see where all the cash is going, or the profitability within the company is going, and also where you can possibly cut costs. If this was inverted, let's say this was 180 and this was 80, they could essentially look to cut 100 million of this if they wanted to, and use that to invest in the money in their businesses. Same thing down here. They could use this capital. Accounts payable is essentially money they have to pay in the future, correct? So essentially what they've done here is they've taken that money from here, or put it here, and they've taken it from here. Essentially is what they've done. So they can use those extra resources, in this case about $100 million, or actually in this case, what about double the, what was it, the number? So 277, they can essentially use this number to invest in other assets. This also means what we'll talk about down here, that it's one side the company could be, in this case, probably massively undervalued. 157. Let's get the per share. Actually, I don't do per share. I don't even know that's on here. I'll leave it on here. 277. So go here. Let me share. We have 84. David, why do we always use the diluted share count?
Because like there could be options outstanding, warrants, all that random crap.
Yes, and again, we always want to be as conservative as possible.
Probably options and like employee share plans and all that stuff.
Yep. So 277 divided by 84 equals 330 euros, $3.30 euros per share. Versus, and I'll get rid of this, 157, 187 dollar, or €1.87 per share. So what does that mean to you guys? This number compared to this number, if anything, what does this mean?
The company, it's like almost double. So the owners, the true earning of this business is doubled what the net income say. So it's understated.
Keep going. What else does this mean? Kind of on a deeper level.
you could take it out, whether it's $3.30, take away 1.8. You could take out excess cash from the business and still be it, I guess.
That's one thing. That's one important thing. There's another one though that's hugely important.
Well, it's undervalued. Oh, oh yeah, there you go. The true economic earning.
Yes, perfect. So this company, again, most people just look at net income. This company is essentially almost earning 2 times more in kind of real world profits than it's earning in net income, which also means that it's about 2 times or about 50% undervalued, at least on this one metric. It's being 50% discounted, almost 50% discounted based on this number compared to this number. Does that make sense?
Yeah.
So to further illustrate that point, again, most people look at PE, correct? I hate PE. So 330.
Price to earning.
So 177%. So that also means you can compare this to PE. So what is their PE ratio right now? Again, I hate the PE. I think it's completely useless. If you followed on the blog for a while, I write about it or post videos about it relatively often. I think it's a completely useless number. This is a perfect example why.
10.56.
So 13.2, oops.
What's the OE equals 4.89? That can't be right.
Well, I'm getting to that.
Oh.
I didn't calculate that right. I got a number of 3.2. That's certainly not, or 3.0 for the PE. That's certainly not right.
Wait, isn't the OE 3.3 per share?
No, I'm trying to
Oh, you're trying to invert it, right? Invert it.
yeah, how when comparing owner's earnings to PE, this is way undervalued again compared to this number compared to this number.
Okay.
And I'm struggling right now to do that. Okay. Okay, so here we go. There's the right number. So essentially, that means
Oh, so how to calculate that?
its owner's earnings equivalent is 5.7 versus a PE equivalent of 13.2.
How do you get the 5.7?
Let me see. I did 3.3 minus 1.87 to get, and then divided the 1.43 or whatever it was, divided by 3.3 to get the 43%.
Then how do you get 5.7 and it was 43%?
43% times 13.2.
Oh, all right.
So this further illustrates the power of owner's earnings. Does this all make sense, guys?
I'm trying to get my head around the calculation.
I think Alice might be right. I think I might be slightly off on the calculation.
I just sort of get it, but I can't really explain it well.
So let's forget about that then. All I was trying to do was illustrate the when you compare it to owner's earnings to PE, what the number is in a kind of real world sense. So from here and above, let's get rid of the last sentence. From here and above, everything makes sense, correct? Okay, so we'll leave that out. So this, again, most people don't even know anything about owner's earnings. If they do, they almost never calculate it because it takes a little bit of time. But hopefully this illustrated the massive power of this number. If you take the time to understand it and calculate it in a real world sense, then you can find potentially undervalued assets and potentially hidden assets at a company that the company could cut as well, expenses that they could cut as well if necessary. Does that make sense, guys?
Mm-hmm.
Did you guys find value in this training?
Yeah, I'm just trying to type what you said before.
Do you guys have any questions about anything at this point? Any questions, comments, concerns, anything? I'm glad you like it, Alice. And again, I'm not joking. People probably think I'm joking when I put you can gain a huge advantage over other value investors just by learning this number in this, hour and 15 minutes we've done this. Because again, most people won't do this. Once you get going, you get faster at it, you can do it an owner's earning calculation in 20 to 45 minutes, depending on the complexity of the company. This, we went over longer on this one because there was a little bit more complexity on this stage of things. But the more you do it, the better you get at it, and the more you'll kind of understand it on a deep level. You guys have any questions whatsoever about anything, any of this calculations, any of this, any of the why these numbers are here, anything?
I wrote a summary for Alex, which it makes sense. It makes sense to me, sort of. So the net income is only 43.3% of the owned earnings. So that's why you take 43.3% of the PE.
Yes, and again, David, you're a math teacher. If I'm not doing that correctly, let me know. I don't pretend to.
That's how I see it.
Okay, I don't.
I think they're
So I don't. I always tell my niece. She always asks me, "Don't you need high-level math for the value investing stuff you do?" I'm like, "No. As long as you understand sixth grade math, you're good to go." So I do not pretend to be a math expert.
Interesting.
So, any questions about anything, guys? Owner's earnings related. There is enormous power in this number. Again, as I've illustrated throughout, and then even at a deeper level, when you talk about things like accounts payable, then you get into an investment float. And that's an entire another subject. That's amazing to learn about. Another of one, actually, pretty much the number one reason Warren Buffett became as wealthy as he did is because of the power of investment float. And that's an entirely another conversation. Again, last time, guys, any other questions, comments, concerns, anything?
I'm good. Oh, was it next section tomorrow, right?
Yeah, for us it's tomorrow, yes.
Yeah.
Alex.
Maybe I'll leave Alice with some resources or something. Maybe you ask him. Like,
yes.
You know,
What is the next step? The lower the better. Not really a targeting number, no, just the lower the better. Alice, do you have any questions about anything value investing finance related? Would you like any resources, any information about any of our programs, anything else? Awesome. Before we get off, I invested in a company in the Czech Republic that got bought out not too long ago. Have you ever heard of this company, Alice? Trans World Corporation. They owned casinos and hotels on the border with Germany and I think Austria.
Maybe you can type it for him.
No, I have not. Okay, interesting company. I'll send you a resource on that because you're from the Czech Republic. I'd like you to read it just to get your thoughts on it. I have your email address. Do you mind actually type? I should have your email address, but do you mind typing it here just in case so I can send you that investment article? The company actually got bought out for, I think, awesome.
Oh, got bought out.
What was that, David?
It got bought out?
Yeah, I got bought out for, I think, almost 1.5, 2 times what I paid for it, or in terms of the share price, at least what I paid for it. It was awesome. I think it was like an $18 million company, so it was awesome. So I love small companies, and yeah, so I'd love to send you that article and get your thoughts on it. All right, you guys. Hopefully you found some value from this. Hopefully you learned a lot. Hopefully you.
I've got one quick question for you.
Yeah.
Did you get a chance to look at the BKI company?
No, I'm gonna look at it. I'm gonna look at it a little bit tonight before we get on tomorrow.
All right, cool. All right.
Yeah. So,
yeah, I think there's a lot of value in that company. I think it's at least 50% undervalued. But
okay, no, we can take a look at that at one of the sessions after we do the Sears one. We can do a case study on that company next.
Yeah. Okay. Cool. Yeah, and just tell Neil or Alice does he want to join us?
I don't know. I'll leave that up to him.
Yeah.
David, I don't like talking about myself, to be honest with you. But hopefully maybe you and David connect, or he can tell you something here about, we'd love to have you in the courses and the masterclass and the programs. And I think you'd learn a ton from them. And we're actually adding certifications to the masterclass and all the rest of our programs soon. So if you're interested, reach out to me. I know you have my information, or I'm assuming you have my information.
Yeah, I'll send him a message.
Cool. Yeah. Awesome. Awesome. So yeah. Until next time, I'll see you tomorrow, David. That's another thing I did want to mention is Alice. We and whoever's watching this on the replay. We meet once a week if we can, if there's no major holidays, if people aren't sick or dealing with kids or whatever. We meet once a week in our coaching program and masterclass program and do stuff exactly like this once a week. So we do case studies on companies, owners' earnings, TV. We talk about all that kind of stuff. So if you're interested, we'd love to have you, Alice. If not, we'll keep doing these free webinars, and I hope you keep learning from the free stuff on Value Investing Journey and the YouTube videos and all that kind of stuff. So.
All right, cool.
All right. Thanks, guys. Awesome. Alice, I will send you that email with that report. And I'd love to hear your thoughts on it, just because it's from the Czech Republic. And I will talk to you guys hopefully soon.
All right, cool. Thanks, Joey. Thanks, Alice. Thanks, Jason.
All right, guys. Yep, of course. Thank you, guys.
All right. Have a good day.
Yep. Talk soon.
Okay, bye.